Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. After 3 weeks of record highs, we had pullbacks this week. Ross takes a look at transports, the Russell 2000, crude, gold, and the Canadian dollar. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, checks in from San Diego. He comments on the state of U.S. real estate, interest rates, inflation, and the U.S. dollar. Reporting from Germany, Merriman, publisher of Merriman Market Analyst on MMA-Cycles.com, talks about financial astrology and the correlation between what the planets and moon are doing and what's happening on the financial markets. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money, Ross.
Good to be with you, Jim. Have
we seen a peak in the stock markets for the year?
I'm thinking definitely for the summer. All the ingredients have been slowly building here. The seasonals were all calling for a decent stair-stepping up into July, and then a break into a first good support area probably in August. But the extent of the rally and the lack of leadership in the final stages here since the end of June. I mean, you've got so few stocks that have been above their 200 or above their 50-day averages. The S&P, 25% of the whole rise in the last month was just Apple and Microsoft. So when you've got a capitalization-weighted index like that, it really can be a real misnomer in terms of what the real action is in the market. The AD lines are not doing well. So this, it's the type of thing you expect to see. Equity markets tend to not have spike highs. They tend to be rolling tops. And if we look back, you can see that, the Russell 2000 topped out the better part of 6-8 weeks ago, and other indices have been doing the same type of thing. So, on the initial break, the S&P, we've got targets that are down around 4,100 there. But the big picture here is that if we look from 2009 and the type of rally that we've had and where we've stopped on the way up and had pauses, this time we're about 560% off that March 2009 low. And if we look at the rallies in previous big bull markets from 1987 crash until 2000, or from 1949 post Second World War into 1966, or you look at the 1920s into 1929, when you were up that 500% or more, the correction that happened was an 11%er. So I think what we've got here is a market that is not just ready for a mild correction, but ready for a pretty steep one. And 11% between here and the end of the year wouldn't surprise me at all.
Anything that looks particularly bad right now?
Well, clearly the transports and the Russell 2000 are the heaviest looking ones out there. You've seen there's very little in terms of rolling over of different stocks there to create any strength, unlike in the big cap indices, there you tend to have, you can get a few stocks that can make them look really good, but overall, these are big tops that we've got in the transports and the Russell, and I think you just want to be a seller on rallies. I've been advising people that even on the S&P, looking for a big enough break, that September put options are a pretty attractive trade at this point, and I think it's when I look at the first rollovers that when you see in things like the S&P and the NASDAQ, the type of break here can be pretty significant within the first 3 to 8 weeks or so. So I think that takes you out to the middle of September, and the options that expire on that third Friday of September are a reasonable bet for anybody who wants to either hedge a portfolio or take an outright speculative position.
What's going on with gold and gold miners?
Well, we had that nice double bottom on the gold. First rally a week and a half ago made the 38% retracement, and off the double bottoms, that's the first thing you look for, the really high probability of that happening. Then we had to pause, and as of this week, we made the 50% retracement, and at that point, we also had one of what we look for is a sequential 9. That's 9 consecutive days with closes above 4 days earlier. That happened on Thursday, and typically gold will go through a pause at that point. So, looked like we should get support back around 1810 or so on the pullback. And actually we saw that on Friday, a pretty good pullback there. What I don't like about this rally as far as gold is concerned is that the miners that had done so well out of the March low, when the market traded out of that March low, the miners broke out very nicely and rallied right up until the middle of May. And if you look at the ratio of miners divided by gold, that ratio was moving in favor. Not only were they moving up, they were moving up faster than gold. And we got to the middle of May, then gold continued to move up. We got exhaustion signal highs going into June the 1st, but the miners were faltering for that last 2 weeks. And since then, miners broke harder than the gold did into the low 10 days ago. And on the rally that we've had here, this 50% retracement, the miners have got no leadership at all. Most of them are still down really hard. Very, very few have had much in the way of a bounce. And to me, that's indicative of weakness. So as far as the miners are concerned, until they can start to show some outperformance, and in this case, the highs of the last 3 weeks, they've been in a fairly narrow range here on that ratio, but if they can manage to take out the highs of the last 3 weeks, that would be a catalyst to say that they're ready to move. But the big overhang here is that to get gold miners going, you typically need both a good gold price and a good equity market. If you don't have both, then the weight of the equity market really weighs on those miners. So, I think it's, time to be cautious from that perspective. Don't put any money into that sector right now, not until they've proven themselves better.
What's going on with crude?
Crude really needed to stay in the $72 to $74 range, and it had pretty good momentum moving up, but it's lost all that momentum at this point. And we closed in the low 71s. Wouldn't be at all surprised to see it because of the general weakness we've seen in the oil stocks for the last week and a half, that oil's probably got a deeper break to come. And if you look at the forward market in oil, there's the front month is the strongest one. That's where there tends to be a bit of a squeeze, not a big one. But as you go and look out in the deferred contracts, they're all at lower levels. So when you see that, that's typically a market that has not got big underlying bullish bias behind it. And once it does start to roll, it wouldn't be at all unreasonable for this break, which I guess started from 76 or 77, to find itself 10% lower, under $70.
The Canadian dollar down 3 cents from its high this year. What's going on there?
It was the commitment of traders numbers, better part of 2 months ago now, that hit extremes at the same time that we got weekly sell signals. We've had 2 good sell-offs in the Canadian dollar, and back in early May when our exhaustion index, that's our measurement of extremes, it got into a sell mode for 3 weeks in a row. Commitment of traders numbers showed exceptionally high numbers as far as the non-commercials were concerned. So those speculators were banking on a higher Canadian dollar. And once it lost momentum, first correction wasn't too bad, down to about 80 and a quarter. A poor bounce, only back to 81 and a half. And at this point, we're 79 and a quarter. We had originally been thinking that this correction would carry us back towards 77, and I wouldn't be at all surprised that that comes into being.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Robert Campbell next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find it online at realestatetiming.com. He's speaking to us from beautiful San Diego. Bob, welcome back to This Week in Money.
Hey, thank you for having me back, Jim.
Bob, the latest issue of the Campbell Real Estate Timing Letter is out. What's in it, and how can people sign up to get it?
Well, they can go to my website, which is realestatetiming.com, and read a sample issue and read a little bit about the most current issue if they like. And for those of you that don't know me, I've been writing this timing letter for 19 years. So this isn't something new for me that I just made a miracle discovery a couple of years ago. I wrote a book called Timing the Real Estate Market where I showed people how to focus on 5 key indicators that give you like super significant tip-offs of which way the housing market is likely to go. And I started writing an investment newsletter on that and been writing it for 19 straight years. So it's been a wonderful business. It's a business I love doing. It's super exciting, and it's especially exciting during times like we're having right now, where real estate, is appreciating here in the United States at record-setting levels.
Bob, do you have any upcoming events?
Yeah, I do. And in fact, thanks for asking. I'm so happy to tell everybody that I have my first live seminar in over a year and a half, probably close to 2 years, on October 23rd, 2021. It's at the La Jolla Marriott, and the title of it is inflation knocking on the door, or is deflation? And I set that topic about a month ago just because I watch inflation and had it been picking up, and boy, oh boy, I couldn't have picked a better title, Jim. This whole inflation scare's getting more and more traction by the day.
Is inflation growing by the month?
Oh, absolutely. Absolutely. In fact, it was the latest reading, headline inflation, which does not exclude food and energy, was 5.4% for June. And that's the highest inflation reading that we've had in the United States in 13 years. And everybody please know that those inflation numbers that come from the government, they're way underestimated. Way underestimated. In fact, that's what I did. I did a lot of writing in the most current issue, my July issue of my timing letter about that, because housing prices are appreciating at the fastest rate in history, and housing prices aren't even included in the CPI, Jim, the Consumer Price Index. They say, well, a house isn't a consumer item. It's an investment item. Well, yeah, I kind of understand that, but still, the American dream is still to own a house. And if houses are appreciating at, here in the United States at record-setting levels, that sure kind of screws up the American dream for a lot of people. And it should be included in the Consumer Price Index, because most people want a house. That's a consumer item. It's not something like food where you have to buy it every year. You might buy it, and live in it for 10 years and then go buy a new home. So it's not that kind of consumer item that should be perhaps measured in a Consumer Price Index, but it definitely should be measured, and it's not included, and it shows you how dramatically the inflation numbers reported by the government, don't reflect the purchases that the average American household makes.
Yeah, fuel prices aren't included in the CPI either, and so many of my sources are saying oil is headed to $100 a barrel.
Well, they have two types of CPI. They have headline CPA that includes food and energy, and then they have core CPI, and they exclude it. And of course, core CPI, and the reason they exclude it is because food and energy are more volatile than a lot of other things they measure. But of course, core CPI is always less than headline CPI, so I'd like to use headline CPI. Don't leave food and energy out of that. I mean, come on, man. I mean, it's what it is. So, core CPI, headline CPI that includes food and energy in the U.S. is at 5.4%, and even though that's a relatively low level, it's still the highest we've seen in 13 years, and what's even more interesting is that number doesn't even reflect the housing cost component of in the CPI, which is measured by what houses rent for, and rents are going through the roof right now. So, as I said in my latest letter, housing cost is the inflation dog that is yet to bite, yet to bark. But it's going to start barking, and it may not be, fully reflected in the numbers for at least a year or so. So, unless everything else just collapses, the housing component of CPI is just going to be rip-roaring for at least the next 12 months. So I assume that CPI is going to do the same.
President Trump hinted in a recent interview interest rates could head back up to 21%. I remember getting a 21% Canadian savings bond back in 1981. What are your thoughts on that?
Well, interestingly, Trump and I are almost the same age. I've known and followed Donald Trump, my whole life because he's a real estate man. I'm a real estate man. And so we both came through the 70s. And the reason he's saying that is we came through that period of time where inflation got up to maximum, at least even as understated it is as reported by the government. It got up to 13.5%, 13.3%, pardon me. Mortgages went up to 18%, and I'm sure that's what he's looking at right now. And everything in life has its cycle, guys. We're in an inflationary cycle right now. What is it fueled by here in the United States? For one thing, it's fueled by massive money creation by the Federal Reserve because of COVID, and also it's fueled by shortages on goods and services and supply chain disruption. So what we have, plain and simple, is what one of my favorite all-time economists, Milton Friedman, used to say: inflation is too much money chasing too few goods. So it's here, guys. And you could say, oh, it's transitory. You don't know that. You had no idea that. And is the Federal Reserve, are they pulling their foot off of the gas pedal with respect to money creation? Oh, hell no. I mean, and all these moratoriums here in the United States, you know, the forbearances where people don't have to pay their mortgages, those are being extended. Eviction moratoriums, those are being extended. You know, we're still living in an artificial economy that's on life support. How long is that going to continue? Nobody knows. But as long as it does, the Fed's going to keep pumping out money like crazy, so that the system stays strong, and that's going to fuel inflation.
In a rising interest rate environment, are HELOCs, home equity lines of credit, a concern?
Yes, they are a concern, and I'm really glad you asked that question, because just in the last week or two, the second biggest bank in the United States, Wells Fargo, just discontinued their lines of credit. They said no more. In 90 days, it's over. I mean, if you have a line of credit, you know, they can call those lines of credit whenever they want, you know, and they're calling in all their lines of credit, and you wonder, you go, why would they be doing this right now? Why would they be I mean, banks love to make money from interest on those things. Why would they be calling in their lines of credit? And of course, it's all speculative, but what people are thinking is right now is this market isn't as strong as you think it is, and those 2.2 million Americans that aren't making payments on their mortgages right now because of COVID, that are in forbearance, maybe a lot of those are going to be hitting the market as foreclosures, as supplies, and maybe, just maybe, that, you know, Wells Fargo looks at what happened in the past and says that, you know, we're going to get in trouble on these mortgages like we did in 2006 through 2012, and we got to start pulling in our reins a little and managing our downside risk. But that's really interesting that that's the only bank that's done that, major U.S. bank that's done that so far. But that's no small bank. That's the second biggest bank in the United States.
Does the Fed need to keep printing money?
To keep the economy where it is right now, at this state, yes, they do. Because if they don't, well, one, if they quit printing money, all of a sudden there's going to be a lot of people that are unemployed that are not going to be able to survive like they have on the excess unemployment benefits that they've been getting, and the once you get on life support like we're on right now, I mean, can you pull the plug? It's really hard to pull the plug. And what Trump was talking about, why he thinks inflation could get out of hand, is what happened during the 70s is that the inflation started going off at double digits, and the U.S. dollar lost half of its value during the 1970s, and when inflation hit, 13.3%, the chairman of the Federal Reserve at the time, Paul Volcker, had to raise interest rates. The federal fund rate, which is now 0, he had to raise it to 22% to save the U.S. dollar, which is the world reserve currency, from collapsing, or we would have had hyperinflation. So let's all of a sudden look how that would matter today. Let's just say, mortgages in the United States right now, 30-year mortgages, are less than 3%. If we get inflation, let's just say at 10%, which from these levels isn't that big of a push, inflation goes to 10%, mortgages would have to be at least 12%, or 4 times what they are right now to have a spread over inflation. Otherwise, it's just that you're losing money by loaning somebody money, and you're not going to do that. At 12%, if mortgage rates went up from 3% to 12%, that would crash the U.S. economy. It would crash the real estate market. One thing it would do, it would crash the U.S. debt servicing would go from about 7% of the total budget, probably up to about 25%. So obviously something's going to get cut out. So what the Federal Reserve may find themselves in a situation here is they have no choice but to keep printing money and keep their fingers crossed, like let's pray for a miracle and hope this all works out, which it won't.
Is the U.S. dollar the best of the fiat currencies?
I don't think so anymore. I mean, all of a sudden you start seeing inflation at 3.5%, at 5.4%. You don't see that in Europe that's on the euro. You don't see that in Japan. I mean, I don't know what it is in Russia. I don't know what it is. I don't believe anything out of China, so I'm not even going to comment on China. People ask me, well, do you have any opinions on China? No. Why? Because I don't trust any of the information that comes out of China. They go, oh, you trust the information that comes out of the United States? Yeah, a little bit more, but not, I don't trust anything that comes out of China. So yeah, I mean, so as a world reserve currency, if all of a sudden, if we start the value of the purchasing power of the dollar starts declining by double digits, for a year or two, that value is going to crash and nobody's going to want U.S. dollars, and they're going to all rush to turn those U.S. dollars in, convert them to something else that is more likely to protect their purchasing power of the money. And all of a sudden, you could see tens of trillions of dollars come racing back home to the U.S., which would create what? Hyperinflation. That money's got to go somewhere. They'll buy anything with it just to get out of the currency. And that's that's one of the ingredients for hyperinflation. And one thing they don't know, one thing that people don't realize about inflation, there's a psychological component too. It's just not pure money printing. People have to come to the attitude to say that all of a sudden, this item that I have today, this can of tuna fish today that cost me $1 is going to cost me $1.25 next year. So what do? You rush out and buy as much tuna fish as you can, right? You get rid of the dollars, and everybody knows that. So all of a sudden the velocity of the money, starts getting higher and higher. The turnover gets faster and faster because nobody wants to stick in the dollar. So the turnover of money drives the prices of goods and services up even more. So it's your self-fulfilling cycle that you get into. We're not there yet, but people are sure worried about inflation. We could get there in a hurry.
What's going on in the U.S. real estate market?
Well, as I mentioned, this has been the strongest real estate market from a price appreciation standpoint in history, which really surprised me after coming off that bubble that we had. I mean, a clear bubble where housing prices in California tripled from 96 to 2006 in 10 years. I said, there's no way we're ever going to see those prices again for a long time. A long time. And here we are, we've already exceeded them. The average price home in California right now just set a new record, $818,000, up 39% year over year. The average price home the median price home in California went up $230,000 in the last 12 months, Jim. In the United States, the median price home went up something like 23%, $67,000. That's how fast prices are appreciating in the United States right now, which makes me, been through these cycles my entire life, which is why I'm qualified to be an analyst in this area. We could be really close to a top here.
Where are we in the real estate cycle with homes selling over asking?
Well, it almost couldn't get stronger, from a price standpoint. But interestingly, sentiment has clearly changed in the last 3 months. Normally, when you have housing prices, appreciating at greater and greater and greater year-over-year gains, that the fear of missing out factor, the greed factor among people, the sentiment, rises along with it. Now we're seeing just the opposite. In fact, Fannie Mae polled has a survey they do every month, and they polled something like 1,200 people or 12,000 people or whatever. 74% of those people said it's a bad time to buy a house. I mean, you've never seen that kind of divergence between the highest year-over-year price increases with the highest ever reading for it's a bad time to buy a house. So there we have sentiment. All sentiment has to do is change. And sentiment can change really quickly. If everybody all of a sudden comes to the conclusion, these houses aren't worth that much. A normal house in California isn't worth $818,000. It's not worth $1.9 million in San Francisco or $1.7 million in Santa Clara, or $850,000 in San Diego. Because the market's driven by buyers. The market's not driven by sellers. A lot of people don't recognize that. A seller can ask whatever he wants for a house. until a willing buyer steps up and goes, I'll take it at that price, that's just a dream price. So if these buyers start backing off from this, you're going to see sales. If this sentiment is real, you're going to see sales start decreasing, inventory start decreasing, and we're going to be in the teeth of a down cycle, which is very, very normal. Very normal. Real estate's very cyclical. Most things in life are real cyclical. So we could be closer to a peak than most people think.
How powerful is housing sentiment?
It's a powerful force, and it's turned very negative in the last 3 months. That's what's interesting. We've had the highest price appreciation ever, and the Fannie Mae survey only goes back to 2010, but it's exceeded all the record readings in the past by a mile. So I know that's not a large sample size, but the fact that things have changed that dramatically, where people are going, this fear, in other words, this fear of missing out, FOMO, F-O-M-O, I think that could be I think there's a good chance that could be a thing of the past. And now we're going to be on the downside, where things correct back to normal again.
What does the lower lumber price mean for home prices?
Well, interestingly, lumber futures have taken, even though they took this huge 400% rise, they've fallen over 300% from the peak. And they're still barely above what their old 10-year norm was. Interesting. That's what the futures market had done. But when I go to Home Depot, a year and a half ago, a 8-foot construction grade 2x4 cost me a little over $2. I go down there today, it's almost $8. So even though the futures prices have crashed down to near the old normal levels, that sure isn't reflected in in what you pay at Home Depot or any other lumber yard for that matter. And let's look at things like plywood and what they call what's this construction board that is used for sheathing on roofs and subfloors and things like that. That's gone up 500% in the last year and a half, and that's still hanging up there. 500%. So I think there's a lot of people that out there that all of a sudden these new homes are being just from the pure lumber component by itself, the price has gone up $35,000 because of additional costs, and that's not including everything else like plumbing supplies, concrete, you name it. That's all gone up too. So there's a good chance that once this inflationary blow off in building materials is over, people could get caught, holding a house that cost $400,000 to build that's now worth $300,000.
Are you watching the real estate market for signals that could lead to a significant downturn?
Yep, and that's just the cyclical side of it, the cyclical end of it. We're 2 years we're about 2 years overdue here in California, for example, for the old cycles. You go back about 30 years, it's roughly 6 years up, 6 years down, 6 years up, 6 years down. Well, the 6 years up expired in 2018, 2019, and I called, I said, this is it. California's now in its down cycle. Then COVID hit, and I said, wow, the market saw that coming, didn't they? That's going to fuel this downturn. Boy, was I, along with everybody else, wrong. The market turned on a dime in May 2020, and it is roaring off to record heights at record-setting rates of price appreciation. And you know what that shows you, everybody? This should be a classic lesson for all of us. Nothing in life is a sure thing. Anything can happen. That's why you can't go all in, have all your ducks in one asset class on anything. Let's say it's all in real estate right now, and everything's roaring up, and all of a sudden the bottom drops out of the market. I mean, you could get killed, and especially if you're an older person nearing retirement. So, I mean, and it's just, you don't know. Interestingly, when everything changed, from down to being up, all my indicators went from down to being up. I just went with the wind. I'm like a weatherman. Which way's the wind blowing? I don't sit there and go and deny it and say, oh, this can't be true. Yes, it is true. So, all of a sudden all my indicators switched from being bearish to bullish about the middle of 2020, and they're still super bullish. Except for a few key indicators that I've just recently followed. But I know from a cyclical standpoint, a correction is way overdue. And also, we could get into an inflationary spiral like we did, where all of a sudden you could see inflation, let's say, go up 10% a year, and nominal housing prices don't do anything; they stay flat. A house in California doesn't go up past $818,000. It stays at $818,000 for the next 3 straight years, and people wipe their brow and they go, "Wow, I'm so glad that happened. I haven't lost any money." And you go, "You know what you've lost? You've lost 30% of the purchasing power of the equity you have in your home. If you sold that home today for $818,000, which was worth 3 years ago, and you collected your money, it would buy 30% less today than it did 3 years ago. You just lost 30% of your money." That's why inflation can trick people so badly, and most people get nailed by it because they get lulled to sleep. They go, "Well, I haven't lost any money." Yes, you have. You lost 10% of your money last year. It's like people today that have money in the bank. I mean, like a 90-day treasury bill. What are those things paying? 0.1%? What's inflation doing? The government says 5.4. You know, I maintain it's between 8 and 10. You're losing 8 to 10% of your money today just having it cash in the bank, which most people think is safe. So, I mean, if that situation persisted for the next 2 or 3 years, you could lose 30% of your money being the most conservative person in the world. So the point I'm trying to make is there's no safety anywhere at any time, everybody. You have to be proactive all along. You can, I mean, and it's a rough game out there getting ahead financially. And I know people that have heard me speak before, but I use this statistic a lot because the statistic has been true, you know, for 50 or 100 years. If 100 Americans reach the age of 65, only 5% are comfortable financially. 95% are not. That shows you how hard it is to get ahead and stay ahead in this world. I mean, is it a magnificent challenge? You're damn right it is. But is it easy? No, it's super hard. But you gotta try. And it's all relative anyway, you know. It's like if everybody loses 50% of their money and you only lose 15% a year, you're the king of the mountain, right? So, I mean, it is all relative like that because, I mean, sometimes in a down market, it's just impossible not to lose money. But it's just don't lose a lot of money where everybody else is getting killed. And then all of a sudden when the recovery starts, you still have most of the that maybe you moved your assets into different asset groups during the inflation, like commodity, like gold, which I've been recommending for the last 2 or 3 years as an alternative to real estate. You know, there's going to be a time to get out of that stuff and go to gold, go to this, you know, if this inflationary wave, you know, that, you know, still has legs underneath it and keeps going on and on and on. And I think there's a better than 50-50 chance that that's going to be the case. We're in a new inflation, guys.
With the huge run-up in real estate prices, what kind of price drops could happen in the low-end, mid-range, and high-end homes?
Well, it depends on the area, of course. But California, we could see a 50% drop. During the last drop, during the housing bubble, housing prices in California dropped between 50 and 55%. I mean, did they do that in the United States? No, the United States only dropped like, you know, around 35%. But the bigger the boom, the bigger the bust. And California is a boom and bust state. And other of these cities, like you see some cities, like here in the United States, like the Midwest flyover states, like Denver, Dallas, they've had super price appreciation. They've been some of the best performing real estate since the bottom of the market back in 2012. Historically, has that been the case where the Midwest states experienced that kind of price appreciation? No! So who knows? We may go back to the old school and say, we're going to go back to what, you know, that houses near the coast are worth money in the flyover state. So I think they're at bigger risk, at bigger risk than anything, only because they've risen farther above their historic norm than someplace like maybe even California.
Is the COVID stimulus check program still going?
It seems to me like it is. Well, they sure haven't come off, you know, like the moratoriums on evictions. That was supposed to expire in June. Then they extended it until July, and now it's September. Who knows how long this is going to go on, Jim? You can't tell. Ask the politicians how long it's going to go on. This thing may go on for years until they pull the plug. The same with these forbearance agreements for not having to make payments on your mortgage. And these stimulus programs. A huge majority of people are still making more money not working than they are working. That's a bad situation. So eventually, reality is going to intervene here, and everything's going to go back, readjust back to normal, where, we could have a big correction all the way across the board. And even places, now, here in California, they're raising the minimum wage. In San Diego, the minimum wage is raised to $14 an hour. Up in the Bay Area, it's $16 an hour. So what are the businesses going to do? Okay, some people think, okay, they're going to bring more technology into the businesses, like a restaurant. All the cashiers are going to be robots and that kind of thing. So there goes your 16-hour unskilled worker that's out of a job again. What's he going to do? What's he going to do? I mean, so this is the scary part where they think that, that minimum wage ought to be a certain thing. I'm a free market economist and always have been. I've been self-employed my entire life, just like my dad. The apple never fell too far from the tree. And I think you should be paid what you're worth. So, and what a company's willing to pay you. From a free market standpoint, I think minimum wage ought to be zero. You think people would make zero? No. If you've got skills, the companies are going to want you. If you've got $16 an hour skills, people are going to pay you $16 an hour. If you're not worth $16 an hour, you're going to be unemployed. I mean, that's the law of the jungle. So that's why, guaranteeing all these minimum wages and guaranteed incomes and, universal basic incomes and this kind of stuff. I don't know. I mean, but we're sure leaning toward the socialist side here in the United States more and more and more. I know you Canadians are already familiar with that. Us, not so much. But people are looking at it and going, oh my God, look what's happening in this country. Nobody goes broke anymore. Nobody goes broke. These office buildings are 50% occupied or less. How many of them have ended up of course, there's a foreclosure moratorium. But what are these all of a sudden, let's say this whole thing's over. Are people going to go flooding back into those office buildings? No. I bet you the occupancy rate is still down it's still going to be, the vacancy rate's going to be 25%. Can those businesses, those buildings operate at a 25% vacancy level at the old prices? Not even close. How are you going to make an investor come in and buy the property? How about lowering the price 35% or so? Okay. Well, the mortgage is bigger than that. Oh, well. Nobody said life's easy, did they? Until the Fed steps in and just makes everybody whole. Nobody loses any money. That's what they're thinking about doing here in California. All these landlords that haven't been paid because of the eviction moratorium. The renters don't have to pay rent. They're thinking about, okay, when this thing's over, that all these landlords are going to be made whole. In other words, nobody loses any money. But the biggest thing in my mind, here's something else that's really interesting that I just noticed today. It's rents. I mean, now that these eviction moratoriums, rental moratoriums are getting closer to ending potentially, right now if a new apartment in the U.S. becomes vacant for some reason, it's being rented at a 17% price greater than it was before. That's how much rents are going to go up. That's huge. Who can afford to pay that? Who can afford to pay that? So eventually this whole thing's going to come to roost, and that's what Trump's talking about. Trump and I went through that inflation, how everybody got nailed to the wall. Inflation. I mean, what do you do with mortgage rates when they're 18%? I mean, and you look at incomes adjusted for inflation. Even using the low inflation CPI numbers that the government uses, is that the average worker the purchasing power of the wages he's earned in the last year and a half have gone down, not up, down. So it could be we could be in the real soup on this one again, guys. Welcome to the world of economics. Things go up, things go down. And politicians, nobody wants to face the music, especially during an election period, and there's always an election period going on. Everybody else just keeps saying, well, just keep this keep this thing together, like my farmer relatives used to say, with bubble gum and baling wire, for a few more days, and we'll get through harvest and everything will be okay. That's the same kind of thing that these politicians do. They just don't panic. Just, if we have to print more money, let's print more money. Let's just get us through another month or two. Then we'll look at it. Oh, we need more money? Let's print more money. We need a little more money than we needed before. Okay, Roger. Check that. Okay, we'll print a little more money. And pretty soon it's out of control. It just gets out of control. I mean, and this isn't like doom and gloom stuff. Look at the history of the world. How many high inflations, hyperinflations, and things like that we've had the last 50 years. There's a lot more than you think, and most of them are politically driven. Governments spend more money than they take in order to buy votes and to keep the economy going. Well, you live beyond your means. You live beyond your means for that period of time. Eventually it catches up with you. Like if you look where we're at right now, if you go back the last 1981 was the high-end interest rates, and they've gone straight down for 40 straight years. Prior to 81, through 41 through 81, interest rates went straight up for 14 years. If I showed you a chart, it would look like the Transamerica Pyramid building in San Francisco. And pretty soon you just look at stuff like that and go, wow, isn't that amazing? How things went from super low to super high, and then they went to super low again. You think that's sustainable? No, it's not sustainable. I mean, if you have to bet, you go, no, that's no way. Now the trend's going to reverse, and we're going to go back to something that's more normal than before. Like, how about mortgage rates at 6%? I mean, that would smash this real estate market. Smash it. Is 6% interest rate, if you look back at 30-year rates going back 40 years, and you look at where 6% is, would you say, oh my God, that's super high? No, in fact, you'd probably say just the opposite. That's still super low. You go, exactly. But once everything becomes, acclimated to 3%, the prices and everything, to 3%, and you double them to 6%, all of a sudden, now something's got to give. Because people can't afford the payment. What has to give? The price. The $800,000 home in median price home in California, now can be purchased, for $600,000. I mean, that's still a lot of money, yeah, but who gets hurt? The guy that owned the $800,000 house. He's lost 20% of his money, and that doesn't even take into account inflation. See, that could be the real wealth destroyer here, Jim. The real wealth destroyer. You could, because housing prices are so high and have exceeded the old, 2005, 2006 bubble by a large amount. If prices start correcting back to the long-term norms, not only would people lose a lot of money in real estate, but they would lose a lot of money in price appreciation. Their $800,000 house would sell for, $500,000 during the course of the next 3 years, while we're experiencing 10% per year price appreciation. So yeah, you get $500,000 back. Is the $500,000, eventually you get $500,000 back. Is that worth $500,000? No. It's worth 30% less because of price inflation. Now you're really screwed. And the only reason I'd say this is that I find these times super, super exciting because there's nothing you can do about it. Nothing good in life comes easy, guys. But you have to be able to adjust with the times. Adjust. And if you don't believe me, read a few books by Charles Darwin. See who survives in the jungle. Is it the smartest? No. Is it the strongest? No. It's those who most successfully adjust to change. Somehow they adjust to change and they survive. And it's no different in the real world. So the thing is that you do the best you can. In the meantime, enjoy the ride. Enjoy the ride the best you can. You gotta try to save yourself, but should you obsess about it? No. If you're gonna obsess about something that you have control over, like your health. But you can move money in and out of the market. There are systems you can use, trading systems that take you out of falling trends and put you into rising trends. And let's say, they may underperform over the majority of the time, but at least you're not going to lose everything. And if you've got enough money set aside, liquid money, to be comfortable, heck, even if you lose 25% of it, you're still okay. The thing is, you don't want to lose 50% of it. Or more. So now you're not okay. So you have to make those adjustments along the way. And the reason I know this, guys, is this. I've been doing this my entire life. I've been interested in markets since I was in high school. I started trading stocks. And I asked my dad, who was a home builder for 55 years, Dad, how do you make money in the stock market? He said, you buy low and sell high. How do you do that, Dad? He says, that's what everybody wants to know. And it's been a interest of mine for, 55 years since then, and still is. So you still have to find some way of getting into good markets and avoiding bad markets. If you want to ensure your survival, if you want to be in the 5% that are comfortable financially at age 65. I mean, that's a magnificent goal. At least you got to try. What can you do? There's lots of things you can do. Most people don't even do anything. Most people invest money. You know how most people invest money? They invest in something when they have the money. Is that good timing usually? No. And you know when they sell? When they need the money. Is that good timing? No, it's normally the worst timing. They've lost their job or their wife's divorced them. Now they got to sell the house, the income property, divide up property, so everybody leaves with half of it. That's the average person's investment strategy. And that's why 95% do poorly. So you need to do better than that, guys. You got to step up.
Bob, we're getting into, I was supposed to start another interview at 3. So can we have really short answers here?
Well, I think we've talked about a lot of things. Okay.
Is California opening up?
Not like the rest of the country.
What needs to be done?
We need a new governor that says it's over. No more masks. Just open it up instead of locking it down.
Do you think we'll ever see normal again?
No, yeah, we'll see normal, but it's going to be a different kind of normal. I think this COVID thing is going to knock, maybe 20%, maybe not 20, maybe 10% of the old small businesses, I think are going to be out of business. I think a lot of small real estate investors, the average real estate investor in the United States owns one rental property. This has been such a nightmare with these eviction moratoriums and these rent raise moratoriums for these guys. These guys want out. They want out. And now you can't even invest in real estate because the government's going to step in and tell you, dictate how you can run your business. Back in the day when Trump and I were younger, back in the 70s, if you owned real estate, you know who was in charge? The person that owned the real estate, and rightfully so. You know who's in charge today? Not the owner of the asset, the person that occupies the asset, Jim. The occupant. You can't get rid of him. They go, that'd be a hardship on him. You're a wealthy landowner. You can't do that. That's a real game changer, especially here in California. And in California, and there's no way I would buy a piece of rental property and rent it out. No way in the world. I'm much too much of a control freak. Where if I want to kick them out and sell the property, I'm going to kick them out and sell the property. I'm a capitalist. I'm not going to have to appeal to a planning board and give the guy 2 years worth of notice where he could try to find some other house and blah blah blah, where the whole market could change. No, that's not my game. So I think a lot of other people feel like that too, because it's changed so dramatically from where the owner's in control to now where the occupant's in control.
What percentage of people own stocks?
Well, we all own stock. Everybody owns some kind of stock somehow, probably in a pension plan, whether it's big or small. But I just read a statistic the other day that 50% of the stocks are owned by 1% of the American population.
Is boomer wealth a big driver of the economy?
Yeah, I'm glad you asked that because there's some that I'm kind of divided on how I think because that 50% of the wealth in the country is also owned by baby boomers. Me, guys like me, baby boomers. And once you get older and you're retired, even though I'm not retired and never will because I love what I do, but these guys aren't producing anything and they have a lot of money. What are they going to do? They're going to spend. So we're back to Milton Friedman's formula. Inflation is too much money chasing too few goods. So nobody's producing anything, but everybody has all this money to spend, and what's it going to do? It's going to drive the prices up of a lot of things. It could drive the prices up on more real estate. It could drive the prices up on exotic cars. It could drive the prices up on vacations, of collectibles, on art. because all these boomers have all this money, and they're not producing anything, and they may just go out and spend it.
Is there bank bail-in legislation in the U.S.?
If you remember back in 2008, the politicians in the United States, two guys named Dodd-Frank, created this bill where they said, to address the financial crisis so it never happens again. And one of the provisions of that bill was that there was no bailout provision with banks. So if banks made stupid loans and took big losses, that's the way it was. Quietly, about 4 years later, Jim, they repealed that aspect of the Dodd-Frank so that banks could be bailed out again. Yes, they can bail, and they can bail in too.
Yeah, that means take money out of your account to pay off their debts.
Yeah, exactly. The banks rule the world, Jim. Everybody, the banks rule the world. They're the protected class. Everybody says, oh, you can't let the banking system fail because the whole economic system would go down. So we got to save these guys. Yeah, it would go down for about, a year, then everything would return to normal. As opposed to it goes back down for a year and it's still not back to the normal, but all the bankers have all the money again.
Are hedge funds buying residential real estate?
Yeah, a little bit, but that's more of a emotional headline than anything else. BlackRock's buying some property and all that, but in the big scheme of things, I think there's something like 200,000 homes or something in the United States. How many 200 million homes in the United States? What percent of those are owned by BlackRock? It's way less than 1%. Way less. They just don't like to see hedge funds buying homes. They think they're out there buying them, hand over fist, and they're not. So 2/3 of all Americans own the home they live in, and that's where the majority of the ownership is. And a small percentage own a rental home. But so that's still the vast. But so is BlackRock a big player? No. But it sure gets people all worked up when they found out they went out and bought an entire subdivision of homes in Texas or something that included 150 homes. They bought the whole thing. They go, oh my God, BlackRock's buying up the whole world. No, they're not. And why not buy real estate's the best performing asset you can own right now. It's appreciating here in the United States at 15% a year, the average home. And what do you get in the bank? Less than 1%. Why wouldn't you buy real estate right now? The key is knowing, when to get out, before the bottom drops out.
How leveraged is the financial system?
Very leveraged. Very leveraged. And it's very leveraged because of this. Because you can't make any money with interest rates, right? Interest rates are super low. So let's say a pension fund or something like that. Their payouts to their retirees are based on a 7% return. Well, 50% of the money is invested in bonds, government bonds, let's say, that make 2%. How are you going to pay out 7.5% when you're making 2%? You can't. So what you have to do is you have to leverage those bonds by 3 or 4 times in order, instead of making 2%, now you're making 8%, and you can meet your payout goals. Yeah, that all works fine and dandy until all of a sudden interest rates go up, bond prices go the other way, and you're caught holding the bag.
Through various age groups, how do people's spending habits differ in an inflationary versus deflationary environment?
Well, I can't give you a good answer on that, so I'm not even going to try. We haven't had a deflationary environment since the 1930s, where my dad grew up in. And I'll tell you, there's no money. People stop spending. Will we ever what's the chances of that happening in the United States? I would say it's less than 10%. Because if you go back in the history of the world the last 50 years and count the number of high inflations versus the number of deflations, it's about 100 to 1 on the inflation side. So we're going to go into an inflationary blow-off. That's what's going to happen. Inflation's going to rise its head. Everything's going to get real scary. People are going to lose money. People can't keep up with the cost of, the cost of living, that wages and everything, it doesn't even come close to keeping up with inflation. So everybody suffers by it. And that's what's going to happen. And that's what Trump's talking about right now. Because he knows. He's been around. He's a smart guy with a brain. He's a real estate man. And he has a brain. He's been around. And, you know, just like I have, I saw what happened. I experienced what happened. I was investing in real estate during that period of time. And, you know, when you all of a sudden you start seeing inflation go off and mortgage rates go to 18%, you're just dead in the water, dude. You're just dead in the water. And people get hurt real badly. And it's just, and what happened then is back in the old days when people got hurt, nobody got bailed out. Today, the banks, the big businesses, they all get bailed out at the expense of the little guy. So that's what's wrong with the system. And the Federal Reserve has just, you know, they just feed into that. They go, oh, we're an independent association that we're not beholden to anybody. Pure BS. Pure BS. They take their marching orders from Congress.
What can all this mean for gold and the bond markets?
Well, gold, I think is going to be a terrific investment for the next, for the next few years, if not more. Bonds are probably going to end up being a terrible investment, you know, for that period of time. You don't want to invest in, so the two things you want to invest in, you know, right now, let's say you had to put your money into two things. Somebody came down and said, Bob, you got to put your money in two things for the next, for the next 3 to 5 years. What would they be? And you don't include the home you live in, right? I don't care if the home I live in goes to zero. I'm going to live near the beach regardless. It's going to be, one's going to be commodities, two's going to be gold and silver. It's not going to be leveraged real estate. Because interest rates are going to go up, the economy is going to get smashed, inflation's going to go up. See, and what people don't understand about real estate is this. Real estate is a credit-driven asset class. And when inflation goes up, typically mortgage rates have to be at least a 2% spread above the rate of inflation. So if you have inflation at 10, mortgage rates have to be 12, or nobody's going to lend the money. But I got to kind of take that back. Somebody will lend the money. You know who it'll be? It'll be the Federal Reserve. They'll just buy up all the assets. So the Fed will own up everything. Ask me how that's going to turn out. I have no clue. But do I think it's going to be good? No, I don't.
Could we be facing a pension crisis?
Of course we could, because all these pensions that by mandate, they have to be in a certain percentage of their portfolio, sometimes minimum 50% in bonds. Okay, they've all got payouts based on a 7.5% return. Bonds are paying between 2 and 3%. How do you make up that difference? There is no difference. Social Security is all of the money that's in Social Security is invested in U.S. Treasury debt, which pays, anywhere between 2 and 3%. All of a sudden, you see inflation go up. I know I like to use 10%, but, you look at that historically, that's not going to raise any eyebrows. People go, oh my God, that could never happen. Yes, it could. It could happen much easier than you think. And all of a sudden, all these bonds drop in value, which Social Security has to sell bonds to make their payouts. Guess what? It doesn't take long before they're out of money. They have no assets. All their money's been paid out. Now everybody else gets screwed. And that's why a lot of kids say that they'll never see a dime worth of Social Security. It's for that reason. They think interest rates are going to go up, the value of what's funding Social Security is going to go down, and there's not going to be any money left for them.
Is purchasing power a concern for people on Social Security?
Absolutely, because they have nothing that to hedge themselves with that. The average person on Social Security, 50% of the money that they have coming in the world is from Social Security. That's your average recipient. He's making about $1,400 a month. So all of a sudden, let's say inflation's going off at 10, that the government says it's going off at 3%, so they give Social Security, what they call a COLA, cost of living increase of 3%. Inflation's 10%. They just lost 7% of their purchasing power over the course of the next 7 months. Can they afford that? No, they cannot afford that. They're in a group of people, the poor group of people, that is least able to afford that because they have no income coming in. Their income is going to get adjusted upward. They're just getting a set return on their money, and they could just get killed. And that's one of the reasons why the government understates Consumer Price Index, CPI. It's because Social Security increases are tied to the CPI. Do you think it's to the government's advantage to be reporting a low CPI or a high CPI figure? Low! And so the little guy gets screwed. The little guy always gets screwed, Jim. I mean, welcome to the world. You know, if you think anybody's going to take care of you in this world and look after your interests, you know that better than you are, dream on. Nobody's going to do that. So that's what it comes down to in this world. You just got to look after yourself the best you can. You know, take whatever action you can to defend yourself. You know, be one of the ones that survive. You know, adjust to changing times. But Social Security isn't keeping up with inflation, with real world inflation that reflects the purchasing, the purchasing activities of what people buy. No, not even close. It's probably half. So it's a losing game. And then you pay taxes on it. Are taxes going up or down? They're going up. So Social Security representatives are going to end up paying a higher tax too. So it's a double screw job.
Could we be heading towards a Japan, Argentina, or Venezuela economic scenario?
Any of the above. And you have to be prepared for all of them. You don't know. I would say it would be more toward Argentina and maybe even Venezuela. The high inflation versus the low inflation scenario. Because, I mean, that's what's going to happen. Of course, if all of a sudden we get high inflation up there and we're the world reserve currency and people are holding the US dollar as a world reserve currency, as a currency of stability, and all of a sudden inflation's 10% and they start bringing all these dollars back home, which is back to the US, and trading them in on something, that's a lot of purchasing power that's going to push inflation even higher. You want anything but US dollars. Anything. Because you can't trade all those US dollars in on Chinese yuan or euros or some Russian rubles, because there just isn't enough of them. So what are they going to do? They're going to come to the United States and buy real estate or buy stocks or buy cars or I don't know what else they're going to buy. Buy cars or art pieces or whatever. They're going to trade them in, and all of a sudden you have trillions and trillions and trillions of dollars just flooding into a country back home. They're all coming home just to buy something. That's the final stage or the early stage even of hyperinflation. And that can last a year or two, Jim, where things get hyperinflated before the whole thing just, collapses.
How important is it to have pets?
Well, I think it's really important to have pets, and that's why you want to own your own home and not be a renter. And I don't care whether, that's why whether the prices are likely to go up or down. I think everybody should own their home, because their home is not that same kind of investment as a piece of rental property or something like that. So you don't want to be kicked out of your home. I mean, I love dogs. We have 2 beagles, and I'm not going to have somebody tell me, well, we've decided to kick you out because you have 2 dogs, and I got to go find a new place to rent that will rent with 2 of the most magnificent dogs you've ever seen in the world, and it's probably going to be some beat up old house that's had pets all the time. So I'm always going to own my own home, and I suggest to people, if you can afford a home, buy a home. I don't care. Just buy a home, because now you have control over that home, where you live. And the only time that, what we're seeing a lot of people in California doing right now is where a home is as much of an investment as a place to live. People are being forced, or by choice, to sell their home in California. Let's say they sell their $818,000 median price home in California and move to Phoenix. You know what they can replace that home for in Phoenix? That same home? $300,000. So they have $500,000 left over to try to survive for the rest of their lives. That makes sense. Now the home's an investment. But most people don't make that move. Most people, the average number of people that they live and die within about 50 miles of where they were born. People don't move around the country like that, on a whim or just to save money, because there's no family there, there's no friends there. So that's a pretty dramatic step. So most people don't do it. But if you had to do it, you could do it. For example, I could sell my house here in San Diego, and I'm sure I could move to Fargo, North Dakota, and own half the place. Am I going to do that? You could give me the whole place, and I wouldn't take it. You could give me all North Dakota for free as a trade, and I wouldn't take it. So, I mean, your home is The home is a special place. You know, it's not the investment like stocks or a piece of rental property is, or whatever else you choose to speculate on.
Do you have any health tips for us?
Yeah, I do today. You know, let me see something here that I just wrote down on my blog on realestatetiming.com. And this one was titled, I just posted it today, How to Be Super Healthy. Because even though I've always been motivated to be comfortable financially, my number one priority for the last 50 years has always been to be healthy, strong, and fit. I don't care how much wealth a man has. If he's in poor health, what's the point? There is no point. As a super healthy 74-year-old, here's something I've learned. When you have a strong immune system, you don't get sick. That's the way your body is designed. And it doesn't matter how strong a flu is, a strong immune system should be able to defend you against it. While Robert Campbell is only a sample size of one, I haven't had a flu shot in 25 years, and I've come down with the flu a total of 0 times. What's the best way to keep your immune system strong and avoid getting sick? 3 words. Don't eat sugar. Don't eat sugar. There it is for you, Jim. That's the best advice I can give anybody that wants to be healthy.
Do you have any wisdom you can leave us with?
That's it. That's all I want people to focus on is that. What's more important than health? What's more important, other than the only financial things I can tell you is you have to adjust to changing times. If real estate's overpriced, get into something that's not overpriced, like commodities or like gold. You know, is the stock market overpriced? Sure it is. Could it go up another, 10 or 20%? Yes. Is it likely to stay there? No. So, you have to find some way of staying ahead of the curve to stay financially comfortable. But even more important than that, you have to find a way to be healthy, guys. And I know that just flies over most people's heads. Most people's heads. But if any of you guys were to go to my website and look at my blog post at realestatetiming.com and look at blog, I got a big picture of me that I just took at age 74 years old. And I challenge anybody to say I look like I'm 74 years old. And it's because I've done this for 50 years. And if you walk the walk, you can talk the talk. You have to have a healthy immune system. You don't load it up with sugar. You stay lean, and I haven't had the flu. Haven't had the flu in 25 years. I mean, and I attribute it all to my diet and how healthy my immune system is. My doctor tells me, he said, if all my patients were as healthy as you, I'd be out of business. I go, good, that's exactly what I want to hear. We all got to look after our needs the best we can, financially, emotionally, and physically with health. And it's a big challenge, but you got to at least try, guys. You got to do your research. You got to eat good foods. Avoid the bad foods. Work out. Stay healthy. Like my goal right now is that I started in, I think it was I'm on the middle of my 3rd month. Actually, the middle of my 4th month. And I said, my goal is to lose 6 pounds of fat, belly fat, in the next 12 months and have 6-pack abs again. You say, 6 pounds in 12 months? Well, that's nothing. Yeah, if you don't have fat to lose and you have to lose 6 pounds of it, that's a lot to lose. But that's my goal. And I just want to do it for bragging rights. I want to show people, be able to lift up my shirt when I'm 75 years old and show people where you can see my ads and say, look, you can do it. Is that important to you? Some people it is. It's important to me. Yes, you can do it. And here's how I did it. That's going to be my new side hustle. I'm going to charge people $250 to tell them exactly how I did it. And you know what's interesting about it is what I've learned. If there's no torture, no hunger whatsoever. It's once you learn how to do it and get into it, it's easy. It's like riding a bike. And therefore you can sustain it. But if you have to go on a crash diet to lose all this weight, you'll never sustain it. You'll just lose the weight back. But the key is to drop the weight with your lifestyle and stay physically fit so you can maintain it, if that's important to you. And that's important to me. I just think it's going to be really cool to be 75 years old and have 6-pack abs. I'm sure that puts me in a very, 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 very small minority of men. And that's one of my goals. Just to show people, look, you can do it. It can be done if that's important to you. So the older you get, I mean, am I interested in doubling my net worth, before I die? Not at all. Am I interested in what? I'd much rather get six-pack abs. I'd much rather play hardball in an over 65 league where I'm playing with ex-major leaguers. Those are the kind of things once you've achieved a certain level of financial comfort, and believe me, I'm no billionaire by any means or even close to it, but I'm comfortable, I'm healthy, I've got a good business that I love, I'm around good people that I love, I've got two magnificent beagles in my life, so what do I need? The only thing that's lacking is six-pack abs.
Bob, how can people find out more about your book and newsletter and your upcoming event?
Okay, go to realestatetiming.com, and it's all on there, just like it sounds, realestatetiming.com. And I know I've been talking about health and fitness and all this, guys, and I'm really proud how I've kept myself fit and in good shape my whole life. And after we've been talking about it, with this latest blog post I put up there, and I didn't announce it. You're the only people I've announced it to. Did I announce it to my database? No. It's just up there. Because the only thing I announce to my database is, financially related stuff, real estate related stuff, and that kind of thing. But it's just so important to me that, about being able to look, 20 years younger than you actually are. Is it possible? Yeah. It's really possible. Is it a lot of work? Yeah, it's really a lot of work. I was running up hills today, and there was this young trainer that was there, and he said, "How many times are you going up that hill?" And I said, 10 times. 10 times. He goes, "Wow." And he goes, "I can tell, man." He goes, "You work it." I mean, he just looked at me, and he could tell that stuff doesn't come easy. He goes, I said, "Thank you very much for saying that." He said, "It's really obvious." He said, "I know what it takes to look like that." He said, "You just don't go to the gym once a week." He said, "This has been a serious thing with you your whole life. I can tell." He goes, "How old are you?" I said, 74. He goes, "Wow." I mean, it's just once in a while somebody says that, Jim, and it makes it all worthwhile. Usually I'd prefer it would be a beautiful woman that's 30 years younger than me, but this guy happened to be a black trainer that looked like he was an ex-professional athlete, so that will have to do at the time. But he just couldn't believe it. He said, "You can tell." He said, you can tell you've been doing this your whole life. That's the only way you're going to look the way you look. And I still have 4 pounds of fat to lose for my gut. But realestatetiming.com, guys, you go there. If you're interested in real estate, a lot of people subscribe to my timing letter, even though they don't invest in real estate because they like the way I think. Because I'm almost 100% data driven. My opinion hardly means anything at all. Before I start writing a timing letter, and it takes me about 10 days, the first 2 days, all I do is accumulate data. And I let the data drive my thinking. I don't start the other way around, starting to think like, gee, for some reason I think this is going to be a real estate bust, that real estate's getting ready to bust, and then seek out data that supports that opinion. I do just the opposite. I look at the data and say, what's the data telling me? Real estate's super strong. Well, that's what we know for sure. We don't know that real estate's going to be a bust yet. We know real estate is super strong. So let's use that data right now because it may stay super strong for 6 months. It may stay super strong for 2 to 3 more years. But that's what it is. That's the current state of the U.S. housing market. It's super strong. So start with there, and then slowly you just start looking for tells, for tip-offs as to when that's going to change. And that, of course, changes your thinking and changes what you write about.
Bob, thank you so much for being on This Week in Money.
My pleasure, Jim. Always nice talking to you. Bye, everybody.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter. You can find it online at realestatetiming.com. He was speaking to us from San Diego. Look up, look way up. We'll explain why when we talk to Ray Merriman next.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Ray Merriman, publisher of Merriman Market Analyst on MMAcycles.com. He usually speaks to us from Scottsdale, Arizona, but he's touring Europe right now and is checking in from Cologne, Germany. Welcome back to This Week in Money, Ray.
Thank you. Good to be with you again. Thanks for having me.
A headline that caught our attention just before we went to air was the moon's supercycle and rising ocean levels will cause coastal flooding in the 2030s, with the strongest floods to be seen in 2033 and 34. And the last time the moon's semi-wobbly orbit had a big flooding impact was 2015. What's your view on this news that came from NASA?
Yeah. Well, I mean, it's an 18.5-year cycle, 18.6-year cycle, which correlates with what we call in astrology the moon's north node. And it, the 18.6-year cycle is a very well-documented, consistent cycle correlating with the economy and world stock markets. The only thing is, the 18-year cycle of the moon's wobble is about 7 years difference from the 18-year cycle that correlates with the economic and stock market cycle. That one last unfolded in 2008, 2009, and is next due in 2026, 2027, give or take a year. So this wobble cycle, its 18-year cycle, began in 2015, which in our studies of market cycles and geocosmic cycles, that was a 6-year cycle. In other words, we had the really long-term bottom, 72-year cycle, 36-year cycle bottom. That was in 2009. And so the first 6-year cycle after that, which is a third of the longer-term cycle phase, was 2015. And that was a 6-year cycle low. There was a big currency disruption caused by the Chinese Central Bank, People's Bank of China, adjusting currency levels. And so that was the first 1/3 phase of the 18-year cycle. And apparently that was the peak of the moon's wobble cycle. So it's interesting they have the same periodicities, but they start at different parts of the century, of the decades. Yeah.
Now, Ray, before we go a little further in the interview, can you explain, you've written several books about the correlation between market cycles and planetary movement. Can you just tell us a little bit about that?
Well, I've written several books. Matter of fact, it's hard to believe, but this year will be book number 60 in my life that I've written, and 40 of them have been my annual forecast book, and the other ones have been on correlations of financial markets, tops and bottoms, to rhythmic cycles, market cycles, and planetary cycles. Probably the one I'm most noted for, there's two I'm most noted for. The first one I wrote on a quantitative study of a financial market to planetary. The first one ever written of a quantitative study was in 1982. I started in 1980 and ended in 1982. That was the gold book, Geocosmic Correlations of Gold Price Cycles. That's what put me on the map. Walter Bresser was my mentor. He was a legend in the study of cycles. He was a director for the Foundation Study of Cycles. He took me to his home one night for dinner, invited me to his house, and then showed me the charts of gold and says, "Ray, what's going on here? There's 6 tops and bottoms in gold here that were the yearly highs in each case. And in each case, it was Mars changing directions, we call retrograde, or going back to direct. In each case, it was a high or the low of the year." He says, is that just a coincidence, or is there something to it? I said, I don't know. He said, well, let me give you these charts, and why don't you go into retreat, so you can find a correlation between astrology, planetary cycles, and gold price cycles. And I did. I found 17 correlations, wrote the book. He sent it to Financial News Network, which is now CNBC. They invited me down to Money Talk, and suddenly I had a new job. I was no longer a consultant to my clients. I now had a market letter that went from 35 people to 350 people in a matter of a couple of days after that interview. So The second book series I wrote that I think established my reputation was The Ultimate Book on Stock Market Timing, Volumes 1 through 5. After I left the brokerage community as a vice president of Payne Weber brokerage house, and before that I was with E.F. Hutton, when I left in 1994, I was committed to finding out if there was a rhythm, market rhythm of cycles in the stock market, and if they correlated with planetary cycles as they did with gold market. So I spent the next 15 years, from 1997 to 2012, writing this 5-volume set, showing these correlations with long-term market cycles, long-term planetary cycles, intermediate-term market cycles, intermediate-term planetary cycles. It was over 1,600 pages, 5 volumes, and those two things put me on the map as a serious researcher when it comes to the study of cycles, correlating planetary movements with financial market cycles. So those are the two most notable things I've done with research and publications.
Is there a difference between using astrology and what I call geocosmic events involving the nearby stellar objects like moons and planets? Because after all, with astrology, you're talking about stars that are billions of miles, light years away, whereas planets are actually in terms of the cosmos next door.
Well, it's an excellent question. It's one I get asked often. And the difference is this: the study of astrology is very broad, and it covers not only the relationships of planets to one another and their mathematical spatial distances and relationships, but it also covers the relationship to a band of constellations known as the zodiac. Okay, when you start getting into signs, like Aries, Taurus, Gemini, then you're dealing with a broader spectrum of astrology, but that's not really geocosmic studies. Geocosmic studies is more the relationships of the planets to one another as seen from Earth or from the Sun. And their relationships form mathematical distances, which are known as aspects. When two planets appear to be together in the sky, as Jupiter and Saturn was on December 21st, just gone by, that's known as a conjunction. Okay, when they're opposite, when one planet's rising and the other one's setting, it's known as an opposition. And then you have the quarter cycles, we call the squares in between. These are the things we're interested in as financial astrologers or, people who analyze planetary cycles related to financial markets, geocosmic studies as we call it. It's planetary mechanics, the relationships of planets to one another as seen from Earth. A very simple way to look at that, Jim, would be to look at new moons and full moons. A new moon is when the sun and moon are together. You can't see them. They're both rising and setting at the same time. But under a full moon, when the sun is setting, the moon is rising. And by the way, there's going to be a spectacular full moon around August 20th to 22nd. When the sun is setting, the moon will be rising with Jupiter. That'll be the next big, beautiful astronomical visual effect in the skies that we're going to have coming up. It's about a month away. So that's the difference. Astrology, as it's commonly understood in society, has to do with signs. Geocosmic studies is not concerned that much with signs, very little. It's concerned with the mathematical relationships, the spatial distances between the planets in terms of angles as seen from Earth. That's what tells us a market is going to reverse. It's going to top or bottom and reverse when one of those things happen.
Yeah, now I was watching a documentary on the Discovery Channel. At one point, I think it was Jupiter was almost in line with the Earth, and then it wandered back out into deeper space. So we can see these planets, and I mean, it could have become a star. It was almost massive enough. You can see how their gravity could have a huge influence on little masses like us that are mostly water.
Well, I think there probably is some kind of a gravitational or magnetic, energetic relationship. I don't know. I'm not a scientist. I'm not an astronomer. But, that's my suspicion because what I see from observation and from my research studies, mathematical studies, statistical studies, is that there is a correlation. I don't know if it's direct or not. I don't know if the new moon causes the market to be a high or if it's just synchronistic. But, statistically, there is a significant difference between new moons and full moons at highs and lows in the stock market. If you go and look at all the stock, this one guy did it from University of Michigan. I can't think of his name offhand. It was some time ago. But he analyzed all the dates of all the stock markets since they began trading. And I think it was like 52% of the time, when there was a new moon within a day of it, you had a high. And something similar, you had a low at the full moon. And that reached the level of statistical significance, because of the vast number of days that he was using in his study in all the markets of the world. So there is some kind of a correlation. It may be gravitational. I suspect it is. We haven't figured out how to measure it, or something else. I don't know. All I know is there is the correlation, and if the correlation is more than 80% of the time, I'm using it, and I'm using it successfully in trading the markets and advising my clients on trading the markets.
Would you prefer we use the term geocosmic instead of astrology then?
Well, I think if you use geocosmic or financial astrology, because when we use financial astrology, most financial astrologers know we're not looking at signs so much as we're looking at planets. So either is fine with me. I guess the one thing that many market analysts, market timers like myself who use planetary studies, some will get offended because, society and academia, in science, in religion tend to, they tend to have a disrespect, a low regard for the concept of astrology, not having ever studied it, but just because of its reputation through the years where there are many charlatans and there are no standards for people practicing astrology that's recognized by many countries. We do have standards, we do have certification exams, we have all that, but it's not recognized on a federal level in most countries. So some people take offense if you call it astrology. It doesn't matter to me because I don't care. As far as I'm concerned, if it works, I'm going to use it. If you want to call it financial astrology, you want to call it geocosmic studies, it works. And I've built up such a reputation over the last 45 years, that I have a niche in the field, and I don't think my clients and clientele, matter too much. They don't care too much about it. But if I'm being interviewed by a TV station, and some radio stations other than yours, they start with skepticism without any kind of background or knowledge of it. They're skeptical, but not in an unbiased way, and that can be a bit offensive if they want me to explain the reasons why they should believe in astrology. You can't make somebody believe in something they haven't studied and looked into themselves. You just can't do it. So I don't have that issue seriously with my clients. And I don't need to or wish to embark upon that path of being defensive about astrology, because as Sir Isaac Newton said when he was asked, why do you believe in astrology? He basically says, I've looked into it and you haven't. That's the difference.
Does it look like geocosmic events have been playing a role in the stock markets lately?
Well, let me say this. To me, geocosmic, planetary aspects, geocosmic studies are amazing. How well they work is amazing. I don't know anything that is better in terms of consistency at timing short-term reversals in financial markets as geocosmic signatures. So, when you ask me, has it been playing a role in the markets lately? I don't know. It's not a causal role, but it's been a very accurate indicator, and a leading indicator, which is what we want as traders. We want leading indicators. We want to know when to expect a change in the trend. And the trend depends upon where you are in the cycle, of course. But whatever the movement is, if the market's rallying into those geocosmic clusters, those periods where they gather together in these aspects, you have a very high probability that rally is going to end and there's going to be a reversal. Now, whether it's going to be a change of trend or just a correction, you need something besides astrology. You need something besides geocosmic studies to figure that out. You actually need to know pattern recognition. You need to know patterns within cycles. You need to know where we are in the cycle to know whether or not that geocosmic signature is going to coincide with a market, a trend reversal or just a correction. You need to know where you are in the cycle. So astrology or geocosmic studies, not enough to guide you through that. You need to know some pattern recognition and cycle patterns to do that.
The Dow topped 35,000 points. What's financial astrology seeing ahead for the Dow?
Well, financial astrology is basically going to tell you where the turning points are from a high or low. The cycle studies, though, and the patterns within it, imply that low we had, June 29th, I think it was. That was the primary bottom. That was probably also, we call it 7.5 month cycle bottom. So it's bullish. The cycle studies suggest we're going to make new highs. However, if we don't make new highs, if we don't make it above 35,091, while the other two markets did, then you have what is known as intermarket bearish divergence. And if we rally into these critical reversal dates, these geocosmic critical reversal dates, and do not make a new high in the Dow, it's a shorting opportunity. And your next one is coming up in about 2 weeks, around August 4th or 5th, give or take 3 days. So if we're rallying into that period and not making a new high in the Dow, in fact, all three indexes, the Dow, the S&P, the NASDAQ, then financial astrology or geocosmic will say that's a shorting opportunity. But until we actually take out that low of, June 29th, until we take out that low of 33,271, the market's still bullish. All your primary cycle bottoms have been higher and all your primary cycle tops have been higher. The trend is bullish. And the trend, these indicate that you're going to make new highs. And until that stops, until you quit making new highs, or you take out that 33,271 low, until that happens, it's bullish. Only when those two things happen does it turn bearish. So right now, we're bullish. We're looking for 38,000 to 41,000.
Is financial astrology foreseeing any market surprises ahead?
Oh, yeah. We're under, we call it Saturn-Uranus, quarter cycle. This is the most important planetary cycle in our study of correlating market cycles to planetary cycles. This happens every 45 years, but the quarter cycles every 11 and a quarter years. And you get long-term cycle highs and lows consistently under that aspect. So this is a quarter-year cycle. It started in February. It ends in December. And we're making all-time highs. And if you go back and look at the last time we had the quarter cycle, it was with the opposition. And that was in the first 5 months of the year that was in November of 2008 through July of 2010. It happened 5 times. And as you know, the long-term, the Great Recession bottom was in March of 2009. So that was the last quarter cycle. The one before that was the dot-com bubble burst. It made an all-time high too. During that, it was in March. Well, the cycle was actually between January and May. The NASDAQ topped out in March. The Dow topped out in January of 2000. The NASDAQ fell 80%. So that, and time before that was the stock market crash of 1987. The cycle, actually, the planetary cycle happened in February of 1988, which is less than 4 months before that. You had the great stock market crash of 1987. So yes, Saturn-Uranus quarter cycle is in effect now till Christmas, and we expect a top during this time and the strongest decline since we had the pandemic low of March 23rd, 2020. That was a 38% decline. The biggest decline since then has been 11%, so we're looking for somewhere more than 11%, not more than 38%, probably not more than 20%, but we are looking for an 11 to 20% decline from the highs that formed before the end of this year.
Gold seems to be in a trading range. What do you see ahead for it?
Yeah, it is in a trading range, but it's a big one. I mean, the trading range goes with that 31 and a third month cycle low we had back on March 8th at 1670. And the high we had after that, or the high we had before that, with double top, which is 1960, 1966. So we're in a wide 300-point range. Now, one thing I'd bring to your attention, when we had that all-time high back in September 2011, gold hit $1,920 an ounce. And then it dropped $400 to $1,520, and it kept bouncing off $1,520. It dropped $400 and kept bouncing off $1,520 and going back up to $1,800, $1,790, $1,800 area. Same thing's happening now. We made this all-time high last year, $2,089. We dropped $400 to $1,673. And you know, that's the bottom, that's important support now. As long as we hold that, we're still in the bullish phase of this new cycle. So what I'm seeing is that we haven't made the high yet. That 1920 we made the, back in March, June 1st, I think it was. That is not the high of the new cycle. That's just the first leg up. So as long as we don't take out 1673, and really as long as we don't take out 1750, the low we had June 29th, I guess it was. As long as we don't take out that low of 1750, this market will go higher, I believe, well above 1920. It will test that 1960 area. If it can close above 1960, then I think we're going to retest the all-time highs again, and maybe higher. So right now we're bullish on gold as long as 1750 holds.
What do you see ahead for silver?
Well, the thing is, we're at the end of a long-term cycle in gold, which means silver is going to be affected too. Because after this next high in gold, which I believe will be in the next year, that will be we call it the 23-year cycle high. It's also 7.83-year cycle high, the 31.33-month cycle high. In other words, it's the end of a cycle. When you get to the end of a cycle, the decline that follows is dramatic. The market will fall probably at least 50 to 90% off that high. So we're in the last phase of the bull market in gold. In the last phase of the bull market in gold, silver is more explosive. It'll tend to rally twice as much percentage-wise as gold will. So they're both, to me, in a bull cycle. Gold has to take out 1960 to get really explosive. Silver has to take out $30.50. If silver takes out 30.50, the sky is the limit. I don't know how high it can go. I don't see gold getting above 24, 2500 if it even gets above 2100. But silver can easily, get above its yearly high of 30.35. It can retest its all-time high of $50 again. Take that out, I don't know where the high is, but for now, we got to be bullish on gold and silver as long as gold stays above 1750, as long as silver stays above $23.75.
What do you see ahead for the U.S. dollar?
That's a good one here. I've got a conflicting signals here for that. I like the idea that the euro and the Swiss franc and the Japanese yen are trying to make a bottom in the first part of July. That was our 3-star geocosmic curve reversal date, the first 10 days of July. And it looks like, well, the euro made a slightly lower low, but it looks like the Swiss franc and the Japanese yen are holding. However, let me back up. As long as that holds, as long as all three of those, the yen, the Swiss franc, and the euro don't make new lows from, say, June 29th, they don't take out the June 29th to July 8th low, they don't take out that low, is bullish to me. And this is a good time to buy because low risk reward. This is what we look for as cycles analysts. A low risk reward opportunity. And we're in it right now, I think. However, I'm concerned about what we call the presidential election year cycle, or just a political cycle. When Democrats are in the White House, the dollar tends to be bullish. And Joe Biden was just elected president, started his term in January. And as he started his term in January, that was the low of the dollar for the year. The dollar has been going up. It's coming down a bit now, but the low of the year is on January 6th, actually, the day of the insurrection, the attack on the Capitol, if you will. That was the low, and within 2 weeks after that, Joe Biden became president. The dollar has been more up than down since that time. So the Democrats in the White House talk about, that relates to bullish dollar. The cycles that I'm looking at, the intermediate term cycles, suggest that the dollar has just topped out and is going to start another move down here, and the other currency is going to start a rally. And if the general cycles are correct, the euro is going to make a new yearly high. It's going to break above 125.5. It's going to get up the high 120s, low 130s. So we'll see. The cycles say we're going higher. The political cycle says don't bet on it yet. So we have a conflict right now, and it's going to take some time to resolve that.
Any thoughts on interest rates?
Well, this relates to what we call the Saturn-Pluto cycle. Saturn and Pluto come together every 32 to 37 years. They came together in January of 2020, just before the pandemic. And all astrologers knew something big was going to happen. We didn't all know it was going to be a pandemic, but we knew something big was going to happen with the economy and with politics. And indeed it did. So the thing I'm trying to get at here is when Saturn and Pluto come together, you get a long-term low or a long-term high in interest rates. So that means that 2020 was probably the long-term low in interest rates, at least in the long end, the 10-year notes and the 30-year bonds. The time before that was 1981-82. That was the all-time high in interest rates in modern history. The time before that was 1947. That was the then all-time low in interest rates, was like 0.25%. So every time Saturn and Pluto come together, you get a 32 to 37 year low or high. And we just had the 32 to 37 year low in 2020. We're not going back down to those levels again in the long-term interest rates as far as I'm concerned. As a matter of fact, it's going to steadily rise gradually at first, probably through the remainder of this decade. It's just going to very gradually rise. But as you get past 2029, 2030, it's going to pick up more rapidly until you get to the peak of the next Saturn-Pluto cycle, which is somewhere around, I don't have it off the top of my head, but it's somewhere around 2055, give or take 5 years. So the interest rates are going up to the middle of the century, in my opinion.
What do you see ahead for crude oil?
Crude oil is in the time band for its crest of the 17-month cycle. Measured from the low of, April of 2020, when I think it dropped to minus $40 a barrel. So 17 months after that would give you September of this year. So we're due for a good correction into September of this year, give or take about 3 months. And that correction should be at least 20% off the highs. So let's say the highs are close to $80, 75 to $80. That means you're gonna drop somewhere $15 to $16, maybe more, off whatever that high is, which would bring you back to the low 60s, mid 50s, somewhere in there. But to me, that's a buy. That's a buy because I think they're going higher yet. I think there's a good chance you're going to see crude oil back to $100 a barrel next year as Jupiter goes back into Pisces. Jupiter rules crude oil. Neptune rules crude oil. Pisces rules crude oil. Jupiter's in Pisces right now. It's going to back off and go back to Aquarius, but then it's going to go back into Pisces the end of this year through the first half of next year. And I wouldn't be surprised to see crude oil back to $100 a barrel then.
What do you see ahead for grains?
I think the grains have topped out. The Saturn-Uranus cycle between January and December, between February and December, we're right in the middle of it now. And I think I think that means we had the top in, we had the top in June, July. I could be a month off, but I think the top is in now for soybeans and corn. I don't know about wheat, but soybeans and corn I think have topped out. And I think they're going to go sideways to down. Yeah, I think the top is in. I think that's a long-term cycle top we just saw.
What do you see ahead for Bitcoin?
That's another interesting one. I mean, it dropped 55% from the high of the year to the low we had back on June 22nd when Mercury changed directions. Went over 60,000 down to 28.8. So that's over 50% correction. Now, my bias is that low, 28,800 and 30,000. I think that's a pretty good support area. If it breaks, yeah, I think you could easily say that you could easily see that Bitcoin could drop back to 20,000, maybe even lower, as this we call the 16-month cycle low is unfolding. The 16-month low, again, measured from, I think the low of March 2020, brings us to July, brings us to right now. but it has about a 2-month orb. So you're in the time band for a low. The question is, was that it, June 22nd? That's pretty much right on time. But it could still make a lower low before we get to September. And if it does, we're going down to, 20,000 area, maybe lower. But as long as we hold that 28,000, 30,000 area, that's good support. And now if we can just break back above 40,000, then that means we're in a new 16-month cycle, and we should see the highs again, if not higher, within the next 8 or 9 months.
How does the U.S. economic recovery look?
Well, this is interesting. It was just a couple weeks ago when President Biden actually bragged a little bit. He doesn't brag a whole lot, but he actually bragged a little bit. He said, the U.S. economy has grown at its fastest pace ever for the first 4 months of any presidential term in history. And dollar-wise or numbers-wise, that is true, but not percentage-wise. There was one presidential cycle where the new term president had a higher percentage growth in the economy than Joe Biden, and that was Jimmy Carter. Now, the interesting thing is Jimmy Carter was the president who was elected the last time under Saturn square Uranus, 1976. That was 45 years ago. Now comes Joe Biden, the next Saturn square Uranus, waning square. He's elected. They're both a little bit alike in terms of personality. They're kind of like the person that you would probably feel comfortable sitting on a porch with, having a beer as sunsets in the summertime, on a plantation or something like that. They're kind of like good old boys in that regard. But their cycles are similar. They're elected under similar cycles. Their personalities are similar. The economy started out great under both of them, but also what started out under both of them was inflation. You had inflation started under Jimmy Carter in the last Saturn square Uranus cycle. You have inflation now starting to pick up under Joe Biden under the next Saturn Uranus cycle. And everybody at the time in 1976 thought, this is just temporary, it's a fluke. It's because there was a surge in crude oil prices and gasoline prices. That'll go down when the next year comes about. But it didn't. It only came down a little bit and then it took off. We may see something similar to that. So how is that going to affect the economy? Well, just like Jimmy Carter had a good first 6-7 months of economy in his term, I think Joe Biden has a good first 6 to 8 months in his term. I do believe after September of this year, the economy is going to start becoming a little bit heavy. It's going to weigh a little bit. It's going to be too much. It's going to have too much debt, too many spending bills to have to make up for, too many policies, if you will. They're going to be hard to overcome. They're going to indicate that would stimulate growth. I just don't see growth. I just don't see much growth in the economy after September. And it's interesting that his own economic bureau, I think it might be CBO's, Congressional Budget Office or something like that, they came out with a prediction of the economy between now and the year 2030, and they show an average growth rate of 1%. That's not a strong growing economy. So I don't think this bodes well unless somehow policies change. And policies aren't going to change unless Congress changes.
We're seeing deadly riots in Haiti, Cuba, South Africa. Were these something predictable through geocosmic events? And are we going to see more of this?
Yeah. Well, this is Saturn square Uranus. This is revolutionary. People are it's protesting, but not peaceful protests. It's protesting that go over the norms of what's acceptable. And it's unfortunate because no constructive changes in governments happen with violent protests. But peaceful protests do lead to substantial and lasting changes in governments. So hopefully the protesters will opt for peaceful protests because that's how things get done. That's how, societies move forward. If you have violent protests, it turns out it could become revolt, it could become revolution. That becomes difficult for the economy and for the country and for society as a whole. But yeah, this shows up. Saturn square Uranus is a classical revolutionary aspect. Remember the last time Saturn was in a quarter cycle to Uranus was Arab Spring. So we're going through something similar to Arab Spring this year. And these things are liable to continue, I think, through the remainder of this year. I think it's a little more peaceful in 2022, but 2020 and 2021 are very difficult, revolutionary, socially disruptive, governmentally revolting periods where rebelliousness is at a peak.
Using geocosmic predictions, how would you shape up a portfolio right now?
Well, I think for now I would still stay in stocks. I still want to be in stocks. I don't. I do see an 11 to 19% decline coming up, but that to me is going to be another buying opportunity. I'm really not going to be ready to sell stocks for some time. I might, as a trader, I might be getting out now. No, I wouldn't be getting out. I'm still looking for the market to go up even a little bit from here. But I would still buy all declines, even the one that's going to be the 23-month cycle low, which is February, give or take about 2 months. Even then, I'm going to buy it, and I would recommend people to buy it. You may want to step aside before that 11 to 19% decline that I see happening around February, give or take 2 months. You may want to step aside, but I would just see that decline as another buying opportunity. So I still like stocks. I still like precious metals into the end of this year, so somewhere between October to December. After that, I want to get out of precious metals. Crude oil, I'd like to see it get back to the low 60s, high 50s to be a buyer. I've positioned myself there. I like currencies right now. As I mentioned, as a trader and maybe even as an investor, I still like the euro and the yen and the Swiss franc, especially is my favorite. I like being diversified into those currencies, maybe even the Canadian dollar. That's my basic portfolio. Diversify with your currencies. Don't have everything in the U.S. dollar. And I would still be looking for buys in precious metals and stock market. I'd hold off on crude oil here. I want to see it drop a little bit, but I'd be preparing to buy there too if it drops to the high 50s, low 60s. That's how I would be structuring my trading plan and my investment plan for the intermediate term future.
Ray, thank you so much for being on This Week in Money. How can people find out more about Merriman Market Analyst?
Well, they can email us at customerservice@MMAcycles.com, or they can go to our website, MMAcycles.com. That is our website. Go to either one of those places, and we'll be glad to answer your question. Or you can call us, 1-800-662-1-800-MMA-3362. Yeah, that's how you get a hold of us, Jim. And thanks for having me on. It's been a pleasure, as always, speaking with you.
My guest has been Ray Merriman, founder of the Merriman Market Analyst and the author of several books on the correlation between market cycles and planetary cycles. He was speaking to us from Cologne, Germany. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Ray Merriman. And thank you for listening. If you have any questions for our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Well, thank you, Jim.
Larry, you believe that you've put out one of your best news releases of the last few months.
Yes, and I'd like to explain the rationale for that. The news release was entitled International Journal of Green Energy publishes peer-reviewed paper describing American Manganese closed-loop battery recycling process. And by the way, this is the second peer review that we've had in the last 6 months. The first was by the Journal of Electrochemical Manganese, JES, and we rated in the high 97th percentile, and very similar to the numbers we're getting on this one. So what that really tells you is this. We've just been, our whole process has been reviewed. Call it a in-depth due diligence, if you want to. And it's been reviewed by several scientists in different locations and has been approved for publication in the Green Energy publications. So that's a big feather in our cap. To have this done twice in less than a year is a whole bonnet for us. So, but what that should tell our investors is that people that are in the know have actually reviewed the submissions by Cametco on the process that they're using for our recycling of lithium-ion batteries and or recycling of scraps, and should give them a very strong feeling of confidence that we are doing what we should be doing, and that our process is not subject to, criticism from armchair guys. And, and that's what they listen to, is these armchair guys on the boards. And the fact of the matter is, these guys are well qualified to evaluate a scientific paper that's prepared by other scientists. And they've given us a thumbs up and published the paper, and we're in the high 97 percentile, or top 5% of all the submissions in the past. I'm not sure exactly how long, but let's say in the past few weeks anyway. And so that should give us some comfort in this market that seemed to take the news as usual as bad news and been pushing the stock price down ever since. And we know where that comes from. We've had 450 million shares traded since the run-up in late December, and that really basically is telling us that that the predator activity is about 50% or more of our trading. And I can't go through a podcast without mentioning this predator trading. I've been talking about it since I started the podcast and for the last 8 years. So I'm not about to stop now. And it's shameful that these guys can do this. What happens is it quits trading on the venture exchange and then trades down after several crosses by predators on the other exchanges that are attached to the venture exchange. So it's disappointing to see that, but the fact of the matter is we've got the goods. We've been verified now by 2 publications, and we shouldn't have to revisit this subject again. The company has diligently and with Cametco's scientific abilities has moved this project into the frontier. We're pioneers in this area, and it will pay dividends in the end, and it's going to and we're not going to stop. It's we're just going to keep going until everything is there and the design is in, and the estimates for the cost of material and the cost of operating are all in, and then we're prepared to really sit down and carve up some deals. And we're talking to a lot of big companies that we have under NDA right now. They're all waiting for the same thing. I mean, it's easy to go out and sell your product to a black mass producer who, in my opinion, doesn't have anywhere to send it, but to an inferior process or to a smelter or to the dump. And so that's what we've striven for, and that's what we've got. I think that the peer reviews are not being recognized by the shareholders, but they should be. They can Google peer reviews. They can see they've been around for 300 years or more, And, that's an awful long time for peer reviews to survive this incident. But you have to have them. If you don't have them, you end up with inferior products on the line. I've never seen, or I don't know of. There could be some peer reviews on some of these shots that you take for the COVID, but I don't know. And because that's where they all started, was in the medical field, and there certainly should be some peer reviews out there, and somebody might want to look that up. If they're following the COVID vaccinations, they may want to look that up. So we're happy. We're happy with those results. We're not happy with the fact that every time we put a press release out, we come under attack. And these are guys that have no feelings for the shareholders, have no empathy. Because all they want is your money in their pocket. They don't give a damn if you're 90 years old or you're 19. And, so all they want is your money. As simple as that. And the easiest way to get it is to sell stock they don't own. So, gang up on the stocks. And mine isn't the only one. There's all kinds of stocks that get ganged up on. I could point out stocks that I think should be trading at $10 and are trading at a quarter of that. So, it goes on. Now, I did have a request to mention what's going on with the new pilot plant where we're going to increase the throughput and everything. And just to tell you, those pieces have been designed and ordered because there's a wait list on everything right now, as you may know. And so we've got that well in the works. We keep, announcing, regardless of the fact that it takes the stock down, we keep announcing our results as we go through and we get them, because we can't sit on them. We have to put them out, and we want to keep the shareholders improved that we're still active. And we're active in 2 or 3 different areas, and recycling is 95% of it. Don't kid yourself. We're not ignoring recycling. Anything else that we're doing, like the Manganese project for the DLA, is only taken up about a few percent of our time. And the reality is that the program we're doing up on the Rocher de Boule property is taking up less of that time. So, we're dedicated to the recycling. Recycling is, we think, is the future. And if we can help it along with other things that we're doing, we'll do that. And remember, we're all shareholders. We all try to increase the value of the stock. And, we all want a reward at the end of the day, or sometime towards the end of the day. And I can't stop anybody from buying and selling, and I can't stop anybody from any of the insiders from buying or selling. It's not part of our policy unless it's selling or buying on insider news, which nobody does. And so that's kind of where we're sitting on that right now. Other than that, we've got hopefully have some results coming next week, and the peer review has been most of my talk today because I think it's going by without people recognize the importance of it. You can have a guy sitting on the BBs or the CEO board and sitting there bum rapping the company or talking about fluff news releases. I don't see anybody else putting any news releases out except sporadic ones, and nothing to do with research and development, nothing to do with the advancement of their product. And yet we get accused of putting out fluff. Well, we know where that comes from, and so let's put that behind us. And other than that, I think the peer review will, with all the reviews that it's getting, is number one out there. And speaking of reviews, we're over 14,000 reviews on our economic standard article, and we expect that to go much higher. So, because it was put out during the long weekend, which was probably not a good timing for us, and because everybody was looking at holidays as they are today, and so the markets are slower, and so this is a good time to start looking at your portfolio and saying, hey, maybe I can afford to get some more stock in this company or that company, and because the values are going down. And anyway, that's kind of the my whole gist of today. And I'd just like to say that I hope everybody has a good weekend. I know I look forward to them, and except for having to do a whole whack of emails, responses, and email reading and everything else, but I don't know what I'd do if I wasn't doing that. Okay, everybody have a great weekend. Thanks, Jim.
Larry, for people new to American Manganese, what's the company all about? Where are you traded, and where can they get more information about it?
American Manganese is a critical metals company that has developed the process for low grades of manganese in the U.S., which is becoming more and more predominant, and we'll start dominating the picture at some point. And from that process, we moved on to recycling of lithium-ion batteries, because after much expense and time, we developed a process for the treatment of low-grade manganese, which was adaptable to in the cornerstone of our recycling. You can get all the information you want at our website, and do your due diligence there. Don't be like somebody who wrote me and said that we hadn't had any news out since the $2.7 million contract to Cametco, and we've had 17 press releases since then. And so obviously they do their due diligence on the pull boards, and don't bother reading the press releases or going to the site. And so you can do all your due diligence on the site. We're transparent. We try to put everything out there and let everybody make their own decisions. And it's working well for us at the time, and we get through these glitches and we move on. Now, we're traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the US QB board under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. You can contact the company by phoning 778-574-4444, or you can email me at LREAUGH@AMYMN.com, and I wish everybody a good weekend.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 16th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.